Hello guys. So today I want to quickly take you through. Sorry, greetings, good afternoon. I trust you are all doing well. So today I want to quickly take you through volatility 75 and give you my analysis and my preview on what is happening on the chart. So from henceforth, what I'll be doing is that I'll basically be bringing you updates, and I'll be giving you analysis on what is actually going to happen, my projections and all that on the chart for volatility 75. Basically, I may other times switch to all the other volatility pairs, but for now I'll basically switch to I'll stay focused on volatility 75. Okay, so let's go to the chart and see a little bit of what it is. So I don't usually trade with I don't trade so much in indicators, so I believe that the typical market structure should show you what is happening on the market for you to also decide and all that. For some of you who are new to this, everything on the chart may sound very confusing and as useless as the chart may just seem too rough to you, okay? But I bet you that if you are going to stay with me here as we progress, I believe things will get better. Basically, my style of trading is from my mentor, Ict Michael, right? So I give all the accord, and I really appreciate his efforts in that he's even now started posting more videos, free videos on his YouTube channel, as I would also be following, and then I also be posting more free videos trying to break down things for some of you who might also like to follow me. But basically, I want you to understand that he is my source of education, and I've learned. If there's anything that I've learned, if there's anything that has become of me today, I feel that I owe him. So thank you, Michael. I might as well talk a lot like him anyway. So so quickly, let's go to the chart, and then I see what is on the chart, and then let me do a few analysis for us to see, so that we quickly run through. So from this chart, you can see that the market started. So let's look at the years. We are going back to time, so we can see this starts from this as of 2001. This year is as of 2001. Somewhere in December 2001. This is where the chart is, where my cursor is. All right. So this side. That's 2001. Right? So going back from 2001 and going back from let me undo from 2000, say going back all the way to 2020 June, all the way into 2001 January. It went let's say this is from January. That's when we began to have some into mid somewhere. It was not quarter of the year. So this is, let's say we're still in 20 March. Okay, so the weekly chart March to experienced the highest in 2021 May. So the market began to 2021, and then some movement. That's a mid-year, and June we had a very high low of some of the year, four quarters, first quarter, second quarter, third, and the final. So we have the first quarter, second quarter, or the third quarter, have them something here during second quarter, the mid-year. Take the thing that happened here, and I want to explain. Let me take my time and begin to explain things one after the other. Have you seen this zone? You see, have you seen this low here? This low here, yes. So actually, when the market was trending, it was in a bullish it was a bullish movement. Usually, we have the lows and the highs. Then the previous low doesn't take down the previous low. You see, and then the highs take down the previous high. That's when we say we are in a bullish market. All right. So, but here we have a low here. At this point, we have a low here, which was now taken down. What it means is that now, if a low has been taken down, it means that the trend has actually changed. My mentor calls it a shift in market structure. Okay, it means that the market is no more bullish anymore, but it is now going to be bearish. The structure of the market has changed, So when the market structure actually shifts, it's like this is the zone this is the area that tells us that the market, which was in a bullish trend, has rather shifted to want to go bearish. But when the market structure shifts, it doesn't mean that it begins automatically. It takes some time before it actually begins to actually erupt and go the direction that it is supposed to go. Okay, give me some few seconds. Hi guys, so sorry, I had to respond to a call. All right, so what I was trying to explain is that usually, so when the market, we notice that this is a sign that the market structure is not going to be bullish again. It's going to now think of going down or trace the bears are going to take over the market. This is one of the clear signs that the previous lows from one of the bullish movement, one of the previous lows has been taken down. So this is it. It's one of the clear previous lows that has been taken down. So now we have a clear indication that, so assuming you are driving on a highway and you see a road sign that says that drive 50 or maybe police checkpoint ahead. What it means is that there is a police checkpoint ahead. Excuse me. Yes, so I was saying that assuming you are driving and then you see a road sign that says that police check ahead, what it means is that you have to slow down because there may be a police barrier just ahead of you, So now on the market, some of these signs are prerequisites for us to know that there is something ahead that's going to happen, So it makes us begin to now adjust ourselves. If we are speeding, now we slow down. It makes us know. So for instance, if you are bullish on that market, at that point, it makes you begin to now prepare yourself to either exit and rethink of a different position on the market, So this is the sign that the market was actually moving, was a bullish movement, and then one of the lows is just raided. So it tells us that now there's going to be a U-turn. But seeing this alone is not just enough. It doesn't mean that it's just going to happen outright. It will take some time before it happens. And it will take, usually in the market, it will take some requirements. The market must meet certain requirements before it begins to fall, all right, or begins to move on that bearish direction. Okay, all right. So if you are someone who follows my mentor, we have the premium prices and then the discount prices. I don't really want to bring it here because it will confuse a lot of people, you know. I may explain that in another video. I use that as a concept to explain further some of my analysis, you know. So now we are trying to say that the markets are shifted. Now we are looking at a point where we can now also join the bears to trade nicely on the market. All right, so now let's look at what happens, how and where we can now join the bears to trade this market. We have seen that there's a clear sign that the market wants to go down. So when is it going to go down and where will it go down? All right, so now let's go to the chart. Sorry, my chart keeps flooding itself with a lot of when my internet goes off. Usually that's what happens. So we have, this is the point where we had the break in market structure. Let me use a different so this is the point where we had the break in market structure. Here. All right, this is the point where we had a break in the market structure. All right, okay. So here the structure was broken from this point. So anything below this shows us that the market has been raided, and then it needs to seek some prices up here. You know, for instance, let me give a typical example. If you want to sell, you have some items you want to sell, what do? You go and look for buyers, right? That's what usually happens on the market. They want to sell to who? But they have to go and look for buyers, you know. So when you see that price has been rated and the market retraces back, it means that it's going to look for places, loopholes where there are a lot of buyers there to now sell to them. You get it? So now the market is trading up, it's going to look for buyers. So where does it find the buyers? We have something we call order block. So take note of the things, some of the things I keep mentioning here. If you have some comments, you can put them in the comment sections. I'll maybe explain them further in my videos. You know, a few concepts. I'm just going to use a few concepts from my mentor to really break down this market for you. Okay. So first off, I've already mentioned break in market structure. What it means is that when the market is trading upwards or downwards, and then it suddenly change course. All right. That's when we say break. The market structure is broken or it's shifted. The market structure is shifted to another direction. Okay. So I've already said something like that. All right. So this is it. When you have market trading bullish, market trending upwards, and then suddenly one of the lows is raided, it tells you that there's a shift. All right. Okay. So now let's look at the chart. There has been a shift here. Now we are looking for buyers up here too. Now I'm going to use one concept. Another concept that I'm going to use more often here is called the order block theory. Okay. The order block theory. Okay, so what is an order block? An order block is basically a point at which the market takes more orders and sell off against or buy off against the market. So for instance, I told you that the market is moving up to look for buyers. So if we get to a point where it finds buyers and it trades off, now it wants to sell. So it finds buyers and trades off. So it means that any block that we find that we call order block, that the buyers will be there to buy and trade off against it. Now that order block becomes a bearish order block, which means that it's an order block that makes the market go bearish or sellers. So you should say an order block that has a lot of buyers that will buy and make us be able to sell to them. Okay, so that is basically it. Then how is an order block formed? An order block is formed. An order block is formed when I'm trying to be quick with it, so pardon me for me speaking quickly, okay? Or let me take my time. So an order block is actually formed, for instance, here, when you have a full bullish movement here, and then there's a bearish movement. See, an order block is formed when the last bullish block, the last bullish candle that will be formed before the bearish movement. when we are looking at it, we are looking from, we have other blocks that is formed. There are, some people may ask, so if I see this, is it another block? Maybe it was the last bearish candle before this bullish move. No, other blocks are actually formed somewhere around the lows and the highs of the market. You know, so this place we had a high, the highest point. So it tells you that this bullish candle we have here can be another block. Can be another block. Usually, when another block is formed, like this one, we have a trend here. The last bullish candle here before they rallied down here, and then they came back up and then rallied down again. Okay. Typically, this is another block. This one here is another block. But usually, my mentor makes me understand that, you know, we have various kinds of other blocks. So, and someone is asking, why am I even using? Why did I put the what's the name? I've shaded only the portion where the candle has a body, and left out where the candle has a wick. You know, so that I consider it as this, that the candle has, or the price action here has a lot of body, it has a lot of buying within the body of the candle, and which makes us understand that, I mean, another block which is formed here has more orders within it. So this one, price usually has to trade into deeper into the markets, like enter deep into the pockets of all those buyers there, sell to them more before it's able to trade off. Okay, so when we are usually using bigger candles, we have what we call mean threshold. Mean in statistics or in finance, mean is the middle. Okay, so the mean threshold is the middle of that candle that you see. So price usually trades and go into the middle of that candle before it trades off. You get it? Okay, so usually it goes into the middle and then it trades off, into the middle and then it trades off. It doesn't usually go beyond. Sometimes if it goes beyond, you realize that the rejection is very quick. You know, that doesn't mean that price can't trade beyond the mean threshold. All right, so that is basically how it is. All right, so this is another block. Price traded into it and then got rejected quickly. Now you realize that this was the point at which, this other block was the point at which we rather even had the break in the market structure. This was what caused the break in this market structure. Good. And then price traded up again, came down, traded up again, and then went into that previous order block. And look at how what happened. Almost to the verge where it was touching the mean threshold of that previous order block, it rejected itself again and then came back up, traded to this point, and then is now going back down again. Now, as the market was just trading up here, it wasn't because of the other block. That is why it just traded up here, because of this old order block. Let me take this thing off so that you don't have a clue. You don't assume that because of that old order block. Okay. Sorry, I'm a very busy person in the office, you know. So that's one. Just by the way. All right. So let me take this thing off and show you something. We assume that this order block took effect when this thing traded into the middle of it, and then even a little bit beyond and all that. Let's just take it off. Why did the market not continue trading down and then came back up here? So one of the tools that really helps my mentor to also be able to know where exactly price would want to, after it has changed course, want to trade actually into and reverse, is what we call the fib levels. Okay, so it's a tool on the what's the name, MT4 or MT5 platform, which you can have, is free to use. So we take, what we take our fib levels from? We take our fib levels from the Fibonacci levels. We take our fib levels from the highest point to the lowest point for which it broke the previous structure. So what is the highest point? This is it. And the lowest point, this is it, where it broke. This was the point where it broke the previous structure. So when it broke and came down here, this was where it began to reverse into. So when you take the fib levels, it has some levels that has already been stated there. I mean, it's there, like there's nothing that can be done about it. You know? Yes. It was based on some calculations, which we are not going to go into that now. So take the fib levels. When you take the fib from this point to the high to the low where it broke the previous structure, you will notice that price has traded to most of the levels. Look at this level. It traded all the way into 38.2 level. There was a rejection there. It came down, it didn't touch the 100, it went back again. Look at this point, it was touching the 61 level, rejection, and then went back again all the way to the 38, came down to the 61 level, back to 38, and then went up into the 23.6 level. This is the point where we actually frame our sell. If we are actually going to look at selling, this is the point where we actually frame our markets to sell. Okay, this is where everything we do sometimes takes place. We frame our markets here. This is where we frame our markets to sell. All right, so it's a 23 level, but you can't just say you're going to sell when it just hits this level. You can't just sell, because from here all the way here is a lot of pips. It's a lot of pips. This point is just it's almost 55. Let's say if you open a lot size of 0.001, you are making a loss of almost a loss of 55. Yes, I'm back. So if you get back into this level, it means that you are losing almost like $55. How much is your account size? How deep is your pocket to even be able to hold trades? So you have to be more precise with your entries, so that you are not always having bigger drawdowns. I mean, can you imagine if you have $100 account and your stop loss is somewhere here? The stop loss is somewhere here. That's almost like a $95. Woo! You can't do that. You can't do that. Your pocket is not so deep to hold such. So you have to be more precise. Now, so to be more precise, what you have to do is that now you have to go down to the lower time frame to get why the market would even break this 23 level, go up a little bit before maybe we see the final retracement. So you have to now break down the chart. This is a weekly chart, so we have to break down the chart. So we are saying that this is our 23 level. Okay, let's just keep this thing here and see why it came all the way here before it reversed. Okay, all right. Initially we noticed that it was somewhere almost in the mean threshold of this particular candle, but although it didn't touch it and all that, but this is not what we are interested in. I'm sure we'll find something better. All right. Okay, so now let's go again to the daily time frame. Boom. So this is the area where we shaded. So could you imagine if you are taking a trade from here? You'd have to be in a trade for how many days? Whoa, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Oh, come on, you'll be fed up. It goes back into this level. I mean, I think you just close your trade and run at loss and to blow your account or something, Yeah. So this is the reason why perhaps we might have taken a trade somewhere here. And this one I had already framed a trade here, and I knew that price was going to go there. So let's go down to the chart and see exactly what would have happened here. So we go back, back. Good. So we are here now. Now, what do you see here? What do you see inside this zone? What do you see? What do you see here? Just going to frame something here. What do you see here? All right. Okay, so this is what I can see. I can see an order block. What is that? Oh, I can't see any other block. Well, there was an order block. Okay, so let me show you. Here we have a very nice order block here. A nice bearish order block daily on the previous day's candle, on the previous highs candle. Nice bearish order block. I usually use the bodies, I don't use them. What's the name? Nice order block here. This bearish candle. You realize that this was the last bullish candle. So this is a bearish order block, So this was the last bullish candle that actually caused the price to rally down. After this high, then boom, 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 boom. It came down here before price retraced into it. So you notice that in the mean threshold of this particular bullish candle, this was where price began to fall. This is the mean threshold. Okay, so let me change the color of this so that you notice, you would see the difference, so that you won't confuse it with what we're looking at previously. So here, this is it. So imagine you frame your trade somewhere in the mean threshold of this candle. I mean, what will be the drawdown? The drawdown will be something, just let's say $12. If you open the biggest, the least dot side, that's just $12. $12 is not much, you know. $12. You have an account size of $100. $12 against what? Against what? Let's say your target would be the low here. How much is that? How much is that? Let's go check. So you open a trade here, and the lows. Come on, you're taking almost $302. I mean, that's quite a good trade to take, you know. Quite a good trade to take. Although this particular drawdown here is unpredictable, but so it means that your drawdown or your stop loss maybe could have been somewhere up here, which was almost like $45. You get it, $45, but you're more certain, you know. I wouldn't even go beyond this. My stop loss wouldn't even go beyond this line. No, it wouldn't go beyond this high, which is just almost like $20. It's cool, you know. Boom, 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 boom. Then you come here. So this was the reason for this particular. Now, another thing I'm going to explain is that if there is an order block and then we find another candle or another block there, another candle that trades into that other blocks and rally away, it also leaves some traces, which can also be another order block. So there's an order block which is formed from another order block, actually gives us a very high probability either sell or buy when price trades to that level. So we had an order block here, and then we have another one also here. Now let me use the full what's the name? Let me use the full candle, because I'm using the body of the candle plus the wick. All right, I'm using the body of the candle plus the wick. So look at that. Look at this. This one usually, when price would usually even reject exactly on the tip, when it touches right even at the tip of this particular block here, price usually rejects. But if maybe it finds some reason why it must go up, it does. But usually price is usually rejected at the very tip here. The only reason why it might go into is when you go down to a smaller time frame. You might find that there is a reason why price must go up a little before it rejects down. So this block now becomes, this candle here now becomes a proportion block. So this is a first order block, second order block. Anything that comes is a proportion. Anything that comes after, is the proportion block. Okay, anything that comes after is the proportion block. All right. So now let's go back to that side and see what happened there. Now you can see that price actually traded and came exactly to this point, and then it got rejected. Why did it happen? Okay, I'm going to explain. Let me go down to a smaller time frame. So now we have already established this order block and the premise, and we are done with it. So let me erase it so that it doesn't make the chart cumbersome. So we are on this one. Price has come back to this and rejected, gone down and came back to it again. So where is the other block here? We can find something here. All right. Okay. Let me just even do some. So I'm even going to show you something. So assuming you were even using the full body plus the wick of this candle, where is the mean? The mean is here. Have you seen where exactly it is? The mean is here. So look at where the rejection was. It tells you that, I mean, it was wild. All right. So you can still use the candles, the full, but sometimes I stick to my body to be more precise, as my mentor taught me. All right. So this is it. Now let's go down to our 4-hour time frame. Let's go back to our 4-hour time frame and see what actually transpired that caused good. We are here. So the market actually traded up, touched the previous order block, the mean threshold, and then came back down, and just came back again. Have you seen the other block that we indicated, that long what's the name, that long daily bullish candle that had a long wick, small body? So this is where it came from. All right, this is where it came from. So now look at it, we have this movement here, price trades and come to this point. Look at this big bullish move, this bullish candle. It actually traded up here and then got rejected, and then this one also got rejected, and then boom, they traded down. Even going down, you may even find something here. Let me show you something. You will still find more other blocks inside other blocks. See, so you notice that this particular bullish candle, the last bullish candle here before the trading down, when you take the mean threshold of it, see the candles, the body of the candles actually didn't want to trade above the mean threshold. It tells you that the price was rather going to rally down. Price was going to rally down, and what happened? Price actually rallied down from here. So where now are we expecting that price would actually trade into? So this line is where the current rejection happened. Where were we expecting the price to trade to get rejected? So if this was the low of the wick of that bullish candle, now under which condition would price trade above it and go beyond and come to this point and want to take orders here? Under which condition? So let me explain. There is what we call a gap. There was some small gap that was not traded into. Okay, there had been some couple of selling, that there hadn't been any buying happening there. So where is that? And it happened here. It actually happened here. It actually happened here. There had been a couple of selling, but there hadn't been any buying. But funny enough, there had been some trades that had happened here already that made this side of the trade completed. So there had been a couple of buying from this point all the way up before the rally down. So you notice that from this point, although this candle sold off, leaving some gap here, there hadn't been any buying, but before this selling off, there had been some buying just above this line, this bullish order block. There had been some buying here before the rally down. So from this point to this point, there's a couple of buying that needs to be done here. So for that reason, price had to trade all the way and come here. And when it touched this one, now this is considered as the order block here, the bearish order block, and it had to trade down against this bearish order block. I hope I'm making sense here. So price had to trade. So when you go to your daily time frame, you realize that it had a wick. It could have rejected it here, but when you go to the hourly, the 4-hour time frame, you realize that no, there was some buying somewhere in the middle where price had not actually traded into. So price had to actually trade into and take down those orders before finally the market had to do that movement. All right. Let me show you another thing too. There are a lot of permits to get your trades right. Look at this trade. Have you seen this wick? This long, the big bullish candle before the small one, before the rally down. It can also be considered. But however, the mean threshold of that candle was where price actually almost traded into. And
hi, guys, yes.
Hello, yes. Sorry, I'm back. So what I was saying, you got to this point where we were looking at the other block, why price had to go into this, okay, and not just on the tip of this, or even if you consider this long bullish candle here, the mean of it, you know, is just this point, you know, and price virtually traded to this point and then reversed. All right, so let's move on. This is, we have established why price had to trade to this point and then it got rejected from this point and then it traded down. Okay, all right, so this is where actually price traded to, touched it, the main threshold, and then the rejection followed. The other line we see here is the low of that bullish, the last bullish candle, the low of it, and then the red line is, let's say, where the price traded to and got rejected. Okay, so even let's say if you had traded, you set your trade at the low of that bullish candle, you have a drawdown of, let's say, from this point to this point, you have a drawdown of, let's say, $25, $23, $25, you know, setting up this trade, and then let's say you have a trade of you, let's say even if you trade off on this low here, you have almost $242, which is quite a good amount of returns, you know. So so price trades come here and then back, and then now you realize that price is not actually trying to quickly rally away from that point, you know. Price is not actually trying to rally away quickly from that point. So you see that price has traded back to this level. So now let's see, when it came here, what actually did it see here that it traded back here? So let me quickly delete everything from the chart, and then we get the chart clear so that we see. So even if we are using the premise of order block theory, we have this as the last bullish candle. Okay, so if we are using this as a premise, okay, if we are using this bullish candle as our premise, so this is where we would have taken trade. Okay, price traded into this, the mean threshold of this bullish candle, and then it got rejected. So let's say there was a drawdown of almost just $5, and then if you had entered a trade from here, at least you would have caught some pip from here all the way down to let's say this point even, or let's say even if it is this point, I'm getting like $67, which is a good amount of money, where I also say that price is still going to retrace down and take down these lows and continue. So if you had already entered a trade here, it's a good point to continue holding the trade. You know, there is no point in trade the price going up above these levels again. Okay, all right, so now let me show you another thing that I have in here. One of the premises, you see where the price got rejected. I'm going to show you something here. So bring in my bar down here, and then to this point. Okay, all right, so now I'm using this candle as my point of reference, you know. So you notice price traded and touched exactly the tip of this bearish candle, the last bearish move before that bullish move that caused the flow down, you know. It also has an impact, you know. Price traded, came down to this point, and then touched exactly at the tip, and then boom, it traded down. So I'm hoping to see that this market would actually trade down, you know. Yes, this is what I'm hoping to see, that price, the market will trade down and take down these lows here. All right, that's my target, you know. Price should take down these lows, or what I'm going to see is that the market may go back and touch this point again before it continues trading down, you know. But I'm not expecting, in as much as the previous day's candle actually broke the low of this, I'm expecting it to trade down, take down these lows. I may not enter a trade now, yes, but this is what I'm expecting, you know. When price actually trades down, okay, when the price actually trades down and takes down the low of this candle, okay, and takes down the low of this candle and comes back to touch this point, that will be my entry. All right, that will be my entry. That will be my, yes. So as I was saying, I'm waiting for price to actually come down to this level, you know, before it actually finally shoots up. So I'm waiting for price to do something like this level, this low, you know, the low of this candle to be broken. So I want price to actually trade down and break this low. When it breaks this low, I don't know, this level or level or just after this level, I'll just where it goes. I wanted to trade back to this point, and then from here, and I'll rather see the market around. So that is my analysis. 25. Now I see for the up again to this level, and then perhaps even break it and come down all the way. I don't see that happen. So for that one percent, whatever that, just I'm hoping that we sell off against, and then well off. What we see is that just wanted to see the rally. Yes, this is what I'm really expecting, you know. So where's my fib? I put the fib from here to here, you know. So I'm actually expecting that price would actually sell off from all the way, come down. I mean, I can take my profit from this level. I can take my profit just below these lows or right on these lows. Price is going to break down through this level, and then it will just do whatever it will do down here. But I want to get a good entry up here. That's basically my main aim and my focus for now. All right. So until we meet again, guys, have a nice evening, and then I hope you did enjoy. If you have any question, I mean, feel free to comment in the comment section, and then please subscribe to my channel, and then let's wait for more videos as we enjoy profit together. Interim, I'll share, I'll put my Telegram link there. You can join my channel, and then I'll be sharing to you when to even take trades and some few signals here and there when I think it's appropriate. All right. Okay, so enjoy your evening, and then keep learning.